Hello. Gold continues to maintain a floor at about 1,700 US dollars per ounce, which sees producers continue to build their cash reserves, pay down debt, and pay dividend, as evidenced by the year-end results coming out this past earnings season. Royalty and streaming companies continue to benefit from the prevailing relatively high prices and prove their robust earning potential even during times of difficulty, such as the COVID-19 pandemic the past year, due to the diversification of their portfolios, which provides a natural hedge against the ups and downs of the performance of any single individual asset. Now, with the base metal sector showing increasing signs of life and higher prices, many streaming and royalty companies are pursuing opportunities to add to their portfolios as base metal miners seek to capitalize on the precious metals byproducts contained within their deposits. The streaming and royalty space will also benefit as the next wave of mergers and acquisitions breaks, as this will move the assets royalties are held on closer towards production. Recent months have seen transactions start to occur with producers looking to consolidate key land packages near their existing operations or acquiring assets that will become part of their future development pipeline. Transactions in recent months have tended to be in areas where companies already operate and where they were able to undertake due diligence visits within the travel restrictions imposed in response to the COVID-19 pandemic. Thus, we have seen transactions in Ontario, Quebec, British Columbia in Canada, and in Nevada in the United States, for example. We're also seeing an increase in strategic investments whereby a company buys a notable, although non-controlling stake in another company, which is often viewed as a down payment on an eventual takeout transaction, assuming the main project of interest continues to develop positively. What is perhaps of most interest to those watching the junior mining space is that recent transactions have shown that premiums are increasing. That is, buyers or strategic investors are paying above and sometimes well above the current share price of the companies they are targeting. This can suggest many things: that the competition for assets is increasing, that companies are seeking to lock in deals which will have strategic benefits or synergies with their existing assets, and that the project pipelines of some companies are not as meaningful as they need to be in order to sustain the business going forward. While the deployment of COVID-19 vaccines is picking up around the world, there is an expectation that travel will gradually become easier later this year, and with that, the ability of corporate teams to go out and undertake due diligence on assets that interest them will increase and improve. As this happens, there is an expectation that M&A activity is only going to increase as the year progresses. Royalty and streaming companies can benefit from growing M&A activity because they may already have agreements in place on assets that are subject to such transactions, but also because they are a source of finance which an acquirer may seek to tap as they seek to structure a deal. Many companies are still wary of taking on new debt, and so streaming and royalty financing can be an attractive option as it does not add debt to a company's balance sheet. And also, the buying and selling of exploration properties often includes the creation of new royalties, which the holder may then seek to monetize ahead of time by selling them on to a royalty company. So the opportunities for royalty and streaming companies are far from exhausted.